Welcome back to the portfolio, everyone. And today we're going over how to become a millionaire in the stock market. This is not a get-rich-quick scheme. This is actually a get-rich-very-slow scheme. This is all about consistently contributing to a nice diversified portfolio. And over the long term of 20, 30, 40 years, you will become a millionaire. And it's almost impossible not to become a millionaire if you are consistent with your investments over the long time. This investment strategy is not flashy. It's not exciting. It's not going to sell very well. This is a slow and steady growth strategy that's going to almost ensure that when it's time for retirement, you're going to have at least $1 million in your portfolio. So this investment strategy is not going to buy you a jet. It's not going to buy you a Ferrari and a mansion, but this is going to ensure that you have nice stability, nice investment retirement egg in there for your future when the time comes. So this investment portfolio is extremely simple. I'm sure you've heard it 1,000 times, but I'm going to go over exactly how you can become a millionaire in the stock market today and what you can do and what steps you can take today in order to reach that $1 million milestone sometime in the future, depending on your current situation. So before we do that, I am the Gen Z investor, and every single day I come out with new stock market videos. I talk about overall stock market performance, all the different kinds of stocks you can buy, as well as any big news or headlines in the market. But today we're going to talk about how to become a millionaire in the stock market. So of course, I am on my path towards $1 million as well. This is my financial freedom portfolio, and I use this portfolio to collect dividend-paying stocks. They pay me quarterly and monthly dividends. I take those dividends, reinvest them back into the portfolio to produce more income-producing assets in order to grow my wealth over the long term. If we take a look here at this article from CNBC, it talks about how much money you need to save each month to be a millionaire in 15 years. So essentially, with the power of compounding, the longer the time you have, the longer time you have your money to snowball, and the greater effect and the greater growth of your money happens long in the future. The first 10 to 15 years, you don't see a lot of compounding effect. Once you hit that 20 plus year mark is when you really see your money grow at a faster rate than you can even contribute to your portfolio. But this article talks about if you want to get it done in 15 years, here's how much money you have to put into your portfolio. So if you're the type of person that really wants to have that $1 million mark coming very soon, and you want to achieve it as soon as possible and as within 15 years, these are the numbers that you're going to want to pay attention. But after we look at these numbers, we're going to break down some other examples that are more realistic for people who want to take that slow and go approach over the long term. So if you're trying to become a millionaire in 15 years, and you have absolutely no savings right now, and you invest consistently each and every month with different rates of return of a 4% rate of return annually versus 6 versus an 8, you're going to need to contribute around $4,000 to up to as little as $3,000 per month. So if you believe you can contribute $3,000 per month to your portfolio with an 8% annualized return, you will hit $1 million mark in your portfolio within 15 years if you're starting at zero. The problem with that, though, is that means you're contributing $36,000 to your investment portfolio with over the next 15 years. So if you're the type of person that's financially stable enough to invest $3,000 per month, which I know a lot of people aren't, and that's an extremely high number, and that's almost impossible. People don't even make $3,000 a month to live on, let alone set aside after tax to invest. That is some crazy milestone, but it is possible if you have the money to do so. Another example, we'll take a quick look at here before we get into, I'm going to say, more realistic numbers. You can see here that if you want to become a millionaire in 15 years and you're starting with $20,000, at that same 8% rate of return, you still need to save close to $2,800 per month. Once again, out of my personal budget, I cannot invest that much right now, but of course, that is a very ambitious goal. Some people may be able to hit it, others may not. We're going to jump into more realistic expectations and what to really expect from your investments over the long term and how to really become a millionaire the very reliable way that I believe absolutely anyone can achieve. If we take a look at how to become a millionaire, the simplest way a lot of people recommend, a lot of great financial advisors, even Warren Buffett, the greatest investor of all time, states the best way for individuals to invest is to own an S&P 500 index fund. So hold a broad market index fund that owns the largest 500 companies in the US by market cap. Hold that, consistently invest each and every month, and in 30 to 40 years, you'll be very wealthy. And of course, that's what we're going to take a look at. So people overestimate the actual returns of the S&P. So you can look on articles and people talking about how the S&P returns 10 to 12% per year. So if you look at the 100-year average, you can see S&P is close to a 10 to 11%. Yes, I understand that. But over the past shorter time frame in more recent history, it's returning around 8% per year. But with regard to inflation, the more realistic number is that you can see, adjusted for inflation, the historical average annual return for the S&P 500 is only 7%. And inflation's coming. Year after year, inflation's going to come. It's the silent killer of your wealth. So you really have to take in consideration inflation when you're doing your estimates and when you're working out these numbers, and I'll show you how we're going to do that, that you want to make sure you're using conservative numbers that you will actually hit. Don't throw into these calculators that you're going to earn a 15% per year over the next 20 years. You're going to outperform the market every single year, and that now you only need to invest $200 a month for the next 15 years. You're going to be a millionaire. Because those numbers are so unrealistic and so hard to actually achieve that you're kind of setting yourself up for failure. Because then you're going to under-contribute to your portfolio. If your overall portfolio does not outperform the market each and every year, then you're going to be kind of upset 15 years down the road when you realize that you aren't at that $1 million mark just yet. Another important thing of compounding, like I mentioned right at the beginning of the video, is that long time frames win. That's how compound interest works. It's an exponential curve. The longer you wait, the more compounding effect, the faster your money grows. So we take a look at this chart here. Before we go into the actual numbers that the chart represents, you can see here the compounding effect, how it works. In the first 10 to 20 years, it's very slow growth. Then the snowball gets bigger and bigger, and it only accelerates the growth over the long term. And the second most important thing with compound interest, of course, is your time frame. The longer time frame you have to invest, the larger your money can grow, the more time you have to grow. So if you're an investor right now who's watching this, that they're 20 years old, 30 years old, 40 years old, the best time to start is today. Don't put it off. Don't wait. You don't need tens of thousands of dollars to start investing. With fractional shares out there right now, you can even start with $1 single. Slow, consistent growth is the way to become a millionaire, and we're going to break down how to do that. I'm going to show you an example of the power of compounding and the difference between starting as early as possible versus starting a little bit later. So investor 1 starts at age 25 and puts away $5,000 per year for 10 years. Then, at the age of 34, that woman never invests again. So you can see here from 25 to 34, she puts away $5,000 per year. So for 10 years, she puts away $5,000. So that's $50,000 over a 10-year span. And at the age of 65 at retirement, averaging an 8% annual return, her net worth is now at $787,000. That's how much her portfolio is worth. And she stopped investing at age 34. She never contributed another dime to her portfolio ever. Investor number 2 starts 10 years after investor number 1. So they start at age 35, but they contribute the same $5,000 each and every month, each and every year. But they put that $5,000 in each year for 30 straight years, from 35 to 65, and their ending portfolio value is still only at $612,000. So investor number 2 contributed 3 times as much money into their portfolio of their own hard-earned money and spent 3 times as much years contributing to that portfolio and still has $150,000 less at retirement than investor number 1, who started 10 years earlier and actually stopped investing before investor number 2 even started. That just shows how important it is to get your money in as early as possible. Let it sit there, let it grow. Don't panic sell. Just let that money grow. Let it go through the rallies and the falls. Hold it, be consistent each and every month. Dollar cost average into the market, and you will see great returns in the long run. We're going to break down exactly how you can do it, and we're going to go down different examples of people in different time frames and what they need to invest each and every month in order to reach that $1 million mark. So for all the examples today, we're going to say you're starting with an initial balance of $1,000. Of course, you can change that number to 0, but of course, we're just going to keep it nice and simple, because a lot of people who are serious about investing and serious about getting into it really can muster up $1,000 to get started. If they can't, you can use these calculators on your own. There's compound interest calculators on the internet for free. There's unlimited different ones that give you different options. I like this one from Acorns, which is like a consultant with CNBC. Very simple, very nice to use, and I really like how the platform works. So you see here, we have an initial deposit balance. So we're starting our portfolio with $1,000. So if you want to start your portfolio, the first thing you really got to think about is how many years until I want to retire. So if we say this person's starting at 25 years old, and wants to retire at the standard 65. So they have a 40-year timeline horizon for investing. And they want to be conservative, and they want to do the S&P average 7% returns. So over the long term, they're going to average 7% annual return on their investments, which is the after inflation rate of return for the S&P. So they want to figure out how much they have to contribute each and every month starting today in order to reach that goal in the future of $1 million at retirement. So with trial and error here, you can start plugging in different numbers in order to see if you reach that goal. So if we were to start with $300 a month, you could see that's not enough. If we want to put in $500 a month, you could see, of course, that'd bring you way over your goal of 1.3 million. But if you want to find that just right number to get started, $375 per month. And if you invest $375 per month for 40 years at a 7% annual return, you will reach that $1 million mark. And what's extremely powerful with compound interest is if we take a look at this final year here, you can see that your total investment into this portfolio is $181,000 of your own hard-earned money, and you've gained through compound interest $825,000. So your investment return has brought in $825,000, and you've only put in $181,000. That just shows you how incredibly powerful compound interest is. And I want to point out here, if you take a look at the first 10 to 20 years of your portfolio, the dark green lines is your capital investment. So how much money you are actually contributing each and every year. If we take a look at the overall trend, you can see for the first 10 to 20 years, there's not a lot of growth. That's why I really want to point out how important time in the market beats time in the market. If you put your money in, the first 10 to 20 years, you barely see any growth. But what happens, look at the last 10 years, from 50 to 60, huge. At year 50, you can see here your total investments at around 143,000. Sorry, 431,000. But then 10 years later, it's more than doubled. So that just shows you how powerful the longer time in the market is, and it shows how the final years have the most growth. Let's just say you believe you're going to actually do a little bit better. You believe in the future, you believe in technology, you believe our total S&P is going to do a little bit better than the last 100 years, and you think you can get a 9% average annual return in the market for the same 40 years. So you think you can do a little bit better than the standard market average. Maybe you're going to pick individual stocks, build your own portfolio, and you think you can outperform slightly the overall market, which a lot of people try to do, and I completely understand. How much you want to invest per month if you're going to get a 9% return? That answer is $210. So if you invest $210 into a portfolio for 40 years and you can average a 9% return, you will hit that $1 million mark at retirement. Of course, now we're doing a different example where maybe you don't have 40 years. Maybe you're watching this video and you are 30, 35 years old and you still want to retire at 65, and now you have less time. So now you have to do is you have to make your own adjustments. You have to come here, switch it. We're going to change it to 30 years. We're going to go back to the original 7% average annual return. And once again, you just have to do trial and error. So if you think $500 can work, you check it out. Not enough to reach your $1 million goal. Maybe you try 1,000, and you can see here that 1,000, of course, brings you to that goal and you actually surpass that goal. But if you're looking to find the perfect amount, if you want to invest for 30 years at a 7% return, you will need to put in $820 per month into your portfolio in order to reach that mark. So you can notice that when we had the 7% return, but we're investing for 40 years, you could only need to put in $375. So less than half of this number, but you had an extra 10 years. Take away those 10 years, now your contributions actually double each and every month, and you have to invest more money each and every month to reach the same milestone as if you were to start 10 years earlier. So that's the problem with this. And no one can go back in time. We can't go back, change the financial mistakes we made in the future. You have to embrace what you have right now, decide today is the day you're going to start working towards your goals, and that's what you have to do. So of course, it's never impossible. The shorter the time frame, the higher the contributions have to be. And of course, if that means to getting a second job, starting a side hustle, doing anything to gain some extra money to invest into your portfolio, then you got to do it. If you're dedicated on reaching this $1 million goal, then you got to do what it takes, and you can sit here, play with the numbers, break down the different rates of return, different amount of years, different contributions, and figure out what is the perfect balance that works for you. Everyone's numbers are going to be different, and of course, that's okay. How it's going to work for me is my number's a little bit different. By the end of the year, I expect my investment portfolio to be around $60,000. And each and every month for my entire working career, I plan on investing $1,000 a month. Currently, I'm 21 years old, and if I plan to invest retire at age 60, that means I have 39 years to invest. If I believe I'm going to get a 7% average annual return, I'm going to have over $3 million within my portfolio if I can continue to do that over the long term. If I want to retire even earlier, so this has me retire, I'm 21, this has me at plus 39, puts me at 60 years old. If I want to retire at 50 years old, I have 20 years, same rate of return, Now I only have 1.85 million. So the longer I have, so if I postpone retirement 10 years and I work till I'm 60 years old, I will have over $3.3 million in retirement. That's my personal plan though. Of course, everyone's numbers are different, and I've run these numbers for myself, and I've done all the different calculations on what I need to do in order to achieve my goals, and I break it down, and that's what made me decide on that $1,000 a month. For me personally, $1,000 a month is my goal. I'm going to budget, I'm going to pay myself first, and as long as I can maintain $1,000 contributions to my portfolio each and every month, I believe that I will do a great job of hitting my investment goals in the future. So that's everything I want to show you guys today. I am the Gen Z investor, and every single day I talk about different videos about the stock market, what stocks you can buy, and overall stock market performance. And today I really want to break down, it is possible for absolutely anyone to become a millionaire in the stock market. It's not flashy, it's not day trading, it's not Forex trading. Slow, steady, consistent gains over the long term, and you can achieve absolutely anything. So thank you for watching, and I will see you in tomorrow's video.